Welcome to the Explainer. Hey everyone, if you're tuning into this right now, I'm guessing you've probably got that familiar knot in your stomach. The clock is relentlessly ticking toward the July 31st, 2026 tax filing deadline for assessment year 2026-2027. You know, you want to do the right thing, you want to file your taxes accurately, but the second you log into the income tax portal, bam, you're hit with an absolute wall of data. Instead of just getting one nice, simple summary of your financial year, you're handed 3 completely different documents. And the anxiety? Yeah, it spikes, because the numbers just don't add up.
Okay, let's dive into this. Honestly, I completely validate the confusion you're feeling right now. I mean, you open Form 26AS, you open the AIS, and then you open the TIS. They are all official government documents. They literally all carry the emblem of the Income Tax Department. Yet you look at your income on one, and it gives you one number. You look at another, and it's something completely different. So what does this all mean? Which one is the actual truth? Which one is the department using to monitor you? And, most importantly, which one are you supposed to use to file your return without getting a dreaded letter in the mail?
Because here is the sheer absurdity of what taxpayers are facing right now. Your traditional Form 26AS might show a standard, totally expected TDS amount based on your salary. Totally normal, right? But then, your AIS might pop up with a vastly inflated total income figure. We're talking sometimes double or triple what you actually earned. I really need you to know that this exact confusion isn't just a minor annoyance. It has triggered thousands of actual scrutiny notices under Section 143(1) and Section 148A. Filing based on the wrong document can literally flag your account for an audit.
So, take a deep breath, because we're going to clear all of this up right now. Here's our roadmap for the Explainer. First, 3 documents, different numbers. Second, meet your tax trio. Third, why the numbers hide. Fourth, the practical trust hierarchy. Fifth, fixing AIS portal errors. And finally, crucial details for NRIs. By the end of this, you are going to have a bulletproof solution for filing your ITR accurately and, best of all, notice-free.
Okay, let's kick things off with Section 1, 3 documents, different numbers.
To put this into perspective, let's look at the massive scale of this issue. If you're confused, you are definitely not alone. Right now, over 8.5 crore, that's more than 85 million ITR filers in India, are grappling with this exact same puzzle as the AY 2026-27 deadline looms. Just think about that number for a second. That is a huge portion of the country trying to untangle overlapping data from Form 26AS, the AIS, and the TIS. Look, the system was originally designed to increase transparency, but for the average taxpayer, well, it's kind of just created a massive data overload. Which brings us to Section 2, Meet Your Tax Trio. To crack this case, we really need to understand the suspects in our tax mystery. So let's meet your tax trio. I like to use analogies here because it really helps break down the jargon and makes these forms instantly relatable. First up is the veteran of the group, Form 26AS. Think of this guy as the original tax passport. Basically, it's your official TDS receipt book. For decades, this was literally the only document that mattered. It gets fed directly by deductors, so your employer, your bank, maybe your tenant, whenever they filed their TDS returns. But, and this is absolutely crucial, here is the big limitation you've got to remember. Form 26AS only shows tax deducted at source. It doesn't show your full income picture. It's legally required for matching your tax credits, sure, but it is definitely no longer the whole story.
Now enter the newcomer that launched back in 2021, the AIS, or Annual Information Statement. Think of this one as your financial CCTV, and this brilliantly illustrates the government's major shift towards total visibility. The AIS aggressively aggregates data in near real time from multiple reporting entities. We're talking banks, brokers, payment gateways, registrars, the whole shebang. It covers over 50 categories of financial transactions: salary, interest, dividends, mutual funds, stock sales, foreign remittances, and yeah, even cryptocurrency. It is the full, high-definition picture of your financial life exactly as the government sees it.
And finally, rounding out the trio, we have the TIS, the Taxpayer Information Summary. If the AIS is the raw, unedited CCTV footage, the TIS is the simplified view. It's the edited highlights reel. It takes all those hundreds of individual transactions from the AIS, processes them, tries to remove the recognized duplications, and then gives you category-wise net values. Now, why does this matter to you? Because the TIS is the actual document that directly feeds those pre-filled numbers into forms like your ITR1 Sahaj. Moving on to Section 3, Why the Numbers Hide.
So if the government has all this amazing data,
Why on earth do these three documents contradict each other so wildly? Now, what's really interesting about this is seeing exactly how the system manages to trip over itself. Let's look at a common scenario, a mutual fund double count. Say you sell a mutual fund. Well, in your AIS, that single exact transaction might get reported once by your broker as a securities transaction and then, wait for it, reported again by the registrar as a mutual fund transaction. Boom. Suddenly, your AIS shows you made double the money you actually did. It's incredibly prone to showing inflated figures simply because of raw data duplications.
And hey, it's not just mutual funds causing a ruckus. Let's break down the practical root causes of these mismatches. Number one is timing lag. Say your employer files a revised TDS return, while Form 26AS updates pretty slowly, while the AIS might update much faster. Number two is interest double counting. Your bank might report interest accrued and then also report interest paid in that exact same period, completely duplicating the amount. And number three is unprocessed feedback. Even if you go in and correct an error on the portal, there are often processing delays, which means your TIS might still stubbornly show the wrong unedited numbers. I want to reassure you, though, these are systemic glitches. They are not taxpayer errors. But you're still the one who has to navigate them.
All right, time for solutions. Section 4, the practical trust hierarchy.
So let's see how all this builds into our primary solution for this explainer. This right here is the payoff. How do we actually use these three flawed documents to file a perfect return? We use what we call the practical trust hierarchy. Here is your highly actionable step-by-step framework. Step 1. For matching your TDS and TCS credits, you trust Form 26AS. That is your official legal record of the tax you've already paid. Step 2. For checking the overall completeness of your income, use the AIS. Basically treat it like a checklist to ensure you haven't accidentally forgotten an old savings account or a small stock sale. Step 3. For understanding exactly where the pre-filled numbers on your ITR came from, look at the TIS. But Step 4, and without a doubt the most important one of all, for your final filing, you trust your own books and records.
I cannot emphasize this crucial rule enough. Your own books, your actual bank statements, your salary slips, those are the absolute gold standard. The AIS, the TIS, Form 26AS, they are merely tools to cross-check your data. They are not meant to replace your actual records. Never ever blindly file your ITR using only the AIS or TIS without physically verifying it against the actual income you received. If you do, you seriously risk heavily over-reporting and paying way too much tax, or under-reporting, which pretty much guarantees a scrutiny notice.
Next up, Section 5, Fixing AIS Portal Errors.
So what happens when that financial CCTV catches the wrong footage? What if your AIS shows, say, 3 lakh rupees of income you absolutely never received? Well, you can't just ignore it. Unaddressed discrepancies in your AIS will almost certainly trigger a notice, maybe 6 to 18 months down the line. So here is the exact sequence to fix the record. Step 1. Log into the income tax portal and navigate over to the AIS tab. Step 2. Carefully review your transactions, keeping a sharp eye out for those duplications or totally unknown income streams. Step 3. Submit official feedback on that specific incorrect transaction right there on the portal. And Step 4. Wait for the TIS to update with your corrections before you file your final ITR.
And the good news is, when you click to submit feedback, the portal gives you very specific options. You can simply mark a transaction as correct, or not fully correct, duplicate, information belongs to other PAN, which actually happens a lot if someone just fat fingers a wrong digit, or information is denied if the record is just completely fabricated. Knowing exactly what to click here empowers you to clean up your financial CCTV footage before the tax department can use it against you.
Finally, Section 6, Crucial Details for NRIs.
Before we wrap up, we absolutely need to address a massive edge case that's been causing a lot of panic among our international audience. The rules for non-resident Indians can honestly make the AIS look incredibly scary. So, the crucial point is understanding how to interpret foreign money on the AIS. You see, the AIS is so comprehensive now that it captures inward remittances, which means foreign income you've sent back to India. Now, for an NRI, remitting your own foreign, already tax-paid income back home to India is generally not taxable in India. But seeing those huge remittance sums pop up on the AIS, yeah, that causes panic. But don't panic. You just need to carefully interpret the data. While the remittance itself might not be taxable, the interest earned on that money sitting in an NRO account absolutely is fully taxable. So just use the AIS to separate the non-taxable remittances from that taxable domestic interest.
All right, we've covered the confusion, the root causes, the trust hierarchy, and the whole correction process. That July 31st deadline is approaching really fast. And as we've seen, the income tax portal is practically overflowing with data that might just be flat out wrong. So I'm going to leave you with this final thought. When you log in tomorrow, are you going to blindly trust the pre-filled numbers the system feeds you, or will you take control and trust your own books? The power to file an accurate, notice-free tax return is entirely in your hands, provided you use the tax trio exactly as they were meant to be used, as a helpful checklist, not a crutch.